Welcome back to my channel, everyone. Thank you for tuning in. And this is going to be a live trading video showing how I made almost $1,300 in profit. And unfortunately, my microphone at the time I was recording this, it didn't capture any of the audio. I'm kind of pissed about, but I'm going to just voice over this video, voice over the different clips that I did capture. And I'm basically going to just go over my thought process and my entries and exits, which I think is going to be very beneficial for all you guys to understand, why I did why I entered where I did, why I exited, and just basically the why and how factor to it. And if you guys enjoyed this video and you learned anything from it and you want to see more videos like this, subscribe to my channel, drop a like, and also follow my Instagram. I post daily trade recaps on there. The link for that will be in the description below. So without further ado, let's get right into the video. So just a little backstory first. So I'm trading the S&P 500 /ES is what I'm charting. And that is directly correlated to SPY, SPX, any S&P 500 related instrument. And that means you could also trade any other S&P 500 related instrument. You could trade SPY options, SPX options, SPY stock. You could trade the future itself. And in this case, I'm trading the micro E-mini future contracts. Instead of the stock, just because it was a Friday. I wanted to have a defined risk. I didn't want to get burned with theta. Yes, you could have played like a week out in the contract's expiration, but I traded the micro E-mini future contracts based off of the supply and demand strategy. So the market sold off really fast into 3-hour demand. Now, when market sells off into demand, you want to see demand start forming inside demand. Really didn't get a clear indication of that right here, so I didn't take this play long. But now we've had, the next 45 minutes for a straight rally up right into 45-minute supply. Another point I would like to make is that these supply and demand zones, I manually draw myself. There's no indicator where it just does it for me. It's subjective. It's basically like an art where you have to find where traders are buying and selling, where you could find trapped buyers, trapped sellers, and basically who's hurting in the market when the market then reacts to a zone. So in this case, we bounced off of the 3-hour demand zone and we started rallying up to 45-minute supply. I do not enter and exit solely when the stock moves up to the zone. I only enter and exit when a stock shows weakness or strength in a supply or demand zone. Then I could take it short in supply and long in demand, but you have to wait for confirmation first, and confirmation could be any sign that sellers in supply are taking over. I'm looking at the time and sales. I'm looking at if prices are coming in on the sales. Are they hitting the bid? Are they hitting the bid aggressively with size? And when they do that, are they lifting the market down with them? I'm also looking at any up, lower, or higher wicks, any chart patterns, anything that's just really telling me that this level is going to provide a rejection and sellers are stepping in. So right now I'm seeing that this 5-minute candle, it tried to make a move up and got rejected. On the time and sales, they were hitting the bid. So when they hit the bid, that is basically aggressive sellers looking to get in a position that are not passive where they're putting a limit order to get short. You want to see aggressive size hit the bid because that's telling us, hey, there's aggressive sellers. So right there, I got in 10 contracts short at 3/2/13.75. Like I said, I'm trading the future contract, so it's directly correlated to the S&P 500 future, and in this case, I'm trading the micro E-mini. So I took it short 10 contracts, and if I could rewind this a little bit, I put a stop loss. So that's the beauty with future contracts, is look, I had a limit order sitting there at 3/2/13.75, and once price hits that limit, I'm going to get filled. And now all I have to do now is put a stop loss above my supply zone, and in this case, it's 3/2/20. And I've manually put a buy stop order at 3/2/20. And then if the stock or the future then proceeds to rally, breaks above the supply zone, I'm just going to stop out for a loss. And I know my loss because it's basically defined. So now that I'm in this thing short, my stop's at 3/2/20, so about a 6-point risk. And my target is at this 3-hour demand, right where my cursor's at. We created somewhat of a 5-minute demand zone inside demand. So I'm targeting really 3202 to 3200 because we have 3-hour demand and we also have a small 5-minute demand. On a 30-minute chart now here on the bottom left, we are also creating higher time frame demand. So the short trade is a little bit of a less higher probability of working out. So therefore, I have to take my profits fast because it's not a trade where everything is aligning up perfectly. So now the market is selling off from supply. I'm 10 contracts short at 3.2, 13 and 3/4. We're coming down into target. When a stock makes an aggressive move up or down after I'm in that position, what I do is I scale out either half or 75% of my position to protect profits, and I leave a couple contracts remaining just to have if the stock wants to continue to drop to the downside, and then you could adjust your stop loss depending on your risk tolerance. So I put a buy order to cover my contracts in case you missed it at 3201 and 3202. And when price comes down to 3202, I'm going to get filled those 5 contracts, and my remaining net position is going to be 5 contracts short, still at 3213 and 3/4. And like I said, if the market wants to proceed to drop, I still have a couple contracts left to remain for a runner basically position. Now, what I like about this and why I did scale out half instead of full position is that this supply zone currently is creating 15-minute supply inside of the higher time frame 45-minute supply zone, meaning more continuation could come. And I basically wanted to see this, provide a little bit of a pullback or a bounce to the upside and then start to continue to come down. But the next clip, you're going to see what happens. And we basically rally, we break the high of the day, and we never come above the supply zone, but you're going to see that in the next clip. Okay, so here's a little tip that I think a lot of traders struggle with, and that's why they stop out at certain points. So you have to put yourself in a position of the market makers and put yourself in a position where traders basically are at who you're trading against. For everybody that's winning, there has to be a loser to that trade too. The stock breaks high of day. Let me pause this here. So when the stock breaks high a day, you want to see follow through. You want to see aggressive volume. So that basically means that it's attracting new buyers and sellers are basically weaker. I drew a downtrend line, so this also lines up with the downtrend line. Keep in mind now, I scaled out. So now I'm still only in 5 contracts short. And now my 5 remaining contracts are basically, I'm losing on them. But because I scaled out, the trade is still green, even though we are above my price that I entered short at. So now I have to respect my rules and keep my stop loss at 3220. It's also confluent with the downtrend line, and this actually did not get above 3220. I don't know if it was just a lucky trade or not, but I had my stop loss, which you could see up here from the 5 stop buy order. I think I put it in the beginning of the clip. So I put a stop loss at 3220 and a quarter, and we pretty much hit 32, I think 19 and a half before coming back down. But you have to realize high a day breaks. This is why I never long high a day breaks and I never short low a day breaks. I'm usually the one that either covers below low a day or shorts above high a day. And in this case, what I'm going to do is now if we start coming below the supply zone, we fail to break the high and we come below supply, what's going to happen is I add to my position and I add 10 more contracts. So like I said, we're stalling at this high and now we're still in supply, broke above high a day, and we cannot hold above it. That is a bearish sign. That's telling me buyers are not strong and sellers are in control. Now what I'm going to do is I wait for the stock to come below supply and then I get short another 10 contracts, which happen right here. So we come below supply. I have my order sitting now. I'm going to put a sell limit basically at the ask, which is going to get filled, and I get filled right there at 3214, bringing my average up to about 3214, 15 contracts short now. Now my stop is about 6 points, and now because we're making higher lows, I want us to test this 3-hour demand again, and I want us to test this smaller time frame demand down here, because more times that a level gets tested, the easier it is for us to break through that zone. And again, I'm recording this voiceover after the fact, when I'm not in the trade, just my thought process of it. But when you actually are in the trade, I'm sure you're thinking a little differently than what I'm saying right now. When you did break above high a day, there was some doubt in my mind that we were going to, continue to rip to the upside. But you have to respect your rules. You have to stick to the plan. As soon as you deviate away from that plan, then, you're going to make this trading decisions based off of your feelings and emotions. And that is not how you're supposed to trade. So like I said before, I always like scaling out. So scale out 50 75% of your position. Watch what it does to your trading, because once you have less size and you take profits, you can afford the stock to bounce without you basically panicking. So I see the stock coming down, and like I always say, when we make a quick move and we start coming down close to my target, no reason to not take some profits off the table, pay yourself a little bit, scale out. So I had an order to buy, cover my shares, my contracts at 3204 and 3/4, which lines up pretty well with this demand, inside demand. And we come down, we hit that, and now let's see if I get filled. So I got filled. I covered 5 contracts at 3204 and 3/4. Now I'm only in net 10 contracts short. I already locked in close to $500, and now this trade is kind of stress-free. I'm only in 10 remaining contracts, and I have an average which is basically 10 points away from where the current stock is trading at. So if we do start bouncing off this demand and we do start putting in higher lows, then I could adjust my stop now lower, which I'm pretty sure I do. I adjust my stop lower as the stock continues to move lower just to protect myself. I can never make the trade turn red on me. All right, so now what I'm focusing on is that how the stock really is not moving down. We're kind of stalling out at this demand, which we did previously right here where my cursor's at. So now I'm a little, nervous for a bounce potential, holding above 3,200. So now I'm looking to cover half more of my position just to protect myself a little more. There's no reason not to. So I put a limit order pretty much near the bid. Pretty much it's at the bid. Now, if you're trading options, you could do the same thing I'm doing. It's the same exact thing. Instead of the future contract, you scale out of your SPY options. It's the same exact thing. So now I'm just, nervous for a bounce up, protect myself a little more, and I'm just trying to get out 5 contracts so I could keep 5 on the table. And if the stock does want to continue to sell off, it's going to be a good trade. And if this does start, to bounce to the upside, not a big deal because I already locked in almost $900. Okay, so what happened here was I was in 5 contracts short after scaling out 5. What looked like to be the S&P was bouncing, which it never did. We actually continued to sell off. We broke below 3,200 and then came below low a day. Now, I said this before, but once we break low a day, I usually cover my position or whatever. I'm breaking above high a day, I usually sell. Just for the fact that I know you have a lot of breakout traders. And if they are not strong enough to outweigh the buyers that are buying down there, then the stock is going to reverse and continue to move to the upside. And that is what we did do. But I covered 3 out of my net 5 below low a day. And now currently I only have 2 net short. And now what I'm going to do is I'm going to put my stop at, I think, at like $3,200 just to protect myself. Every tick is $2.50. So, I have an average of 312.14. I could definitely afford a couple points to the upside. So I don't know what happens here. I'm still in net short 2. I have a stop set at 3197. We go above it. Can this fail and come lower? I don't know. And there we go. I just got filled at 3197. I closed out total. I was in 20 contracts between adding and scaling out for a profit of 1280. And then eventually the S&P did, break low a day, fake out. We reversed to the upside, and where I scaled out was a good trade. And this is just, it's hindsight, or not. It's not hindsight. It's after the fact, me explaining this. And like I said, my thought process as it was developing and going down might have been a little differently, where I could explain it after the fact that it did happen. But this was a good trade. Execution wise was pretty perfect. It was lucky that I did not get stop out. I missed it by maybe 2 or 3 ticks at the high of day. So I guess you could consider this a lucky type of trade. But I hope it helped with going over my thought process, kind of a review of this day trading recap. And I hope you guys enjoyed it. Drop a like, comment, and subscribe to my channel. Thank you.